Hi there, welcome to Kneppy Invest. Only two more videos to go in this project that I started in June 2023, almost 1 year ago. The first particular series in this project, I focused on those companies that were or had a market cap above $1 billion. And in this particular series, I'm focusing on companies that had a market cap below $1 billion. Now, I'm looking for the best performed companies on the ASX during a 10-year period between 2013 and 2023. And the original reason I started this project is I wanted to find the characteristics of high quality companies. Now, the definition of high quality company could be quite different from one investor to the next. And the good way to get around that is just look at the performance of companies over a 10-year period and find the characteristics of these best performed companies on the ASX during that time span. Now, I have my own prejudices, my own thinking when it comes to high quality, and I want to test my biases. And this was a good way to do it. And to be honest with you, my biases are probably confirmed by this particular project. So before I started this project, I thought high quality um, is sort of revolves around revenue growth, revolves around earnings per share growth, return on equity, return on invested capital, that sort of thing, not including management quality, because that is harder to define. You can't really quantify management quality, can't really quantify exactly moat or competitive advantage. In a way, you can by looking at margins, gross margins, that sort of thing. But I really wanted to quantify and have a look if we can discover the similar characteristics of high quality companies. And that is what I aim to do in this particular series. So, to find and draw up the list of these 30 best performed companies on the ASX, both with a market cap above $1 billion and market cap below $1 billion, I needed some rules. So, let's have a look at those rules right now. So, in this particular series, focusing on companies with a market cap below $1 billion as of May 31st, 2023. And that's when I started this particular project. The next rule was pretty simple. Uh, to define a high quality company, I think a company needs to be making revenue, preferably a large amount of revenue and growing revenue at that. So when I drew up this list of best performed companies on the ASX, and that refers to not only capital appreciation, so share price increasing, but also dividends. When I drew up this list, I excluded any companies that were not making any revenue, and I wanted to exclude any companies that were not making a profit. Now, that's difficult because at some point during the last 10 years, many companies on the ASX may have had one bad year where they did not make a profit. So that was true for many companies within this particular list of companies with a market cap below $1 billion. Another thing I excluded were mining companies. And in my opinion, and you might disagree with me here, in my opinion, mining companies, by their very essence, cannot be high quality because they're cyclical and they are price takers. Now, my opinions on BHP is changing slightly, where I think you could make an argument that BHP is a high quality company. That's probably the only company that is a mining company that I could change my opinion on when it comes to my belief that mining companies can never be high quality. So, zero mining companies in this particular list. And I am looking at total returns. I've already mentioned this. So, total returns equates to share price change plus dividends. Dividends is very important, particularly when it comes to bigger, more mature companies. And many companies on this list, however, aren't quite mature enough to be defined as that. But however, in saying that, many of these companies in this particular list do provide their shareholders with a dividend. Now, this is a very important point. Just because these companies performed really well over a 10-year period doesn't mean they're necessarily going to perform really well over the next 10 years. Now, I am looking at similar characteristics among all these companies. So 30 companies in this particular series, 30 companies in the original series, with looking at those companies with market cap above $1 billion. But just keep in the back of your mind, just because these companies perform really well between 2013 and 2023 doesn't necessarily mean they will perform really well over the next 10 years. So coming in at number 10, we have Lindsay Australia. And there is one reason why this company has made it onto the list, and that will become clear when we look at the chart. So some of the things I'm looking at here for all these companies is revenue growth, earnings per share growth, dividend growth, gross margins, return on equity, and analyzed total return. So if you bought Lindsay Australia in May or May 31st, 2013, you made 27% per year if you held it for a 10-year period. This is on the back of revenue growth being about 10%, earnings per share growth 14%, dividend growth 10%, gross margins of 35, and return equity 13.4. So some of those numbers aren't that spectacular, but still a total analyzed return of 27.1% per year. The markup in that period of time grew from 42 million, which seems fairly low now, to 392 million. And remember, that market cap is of May 31st, 2023, not right now. Shares and issues slightly increased from 230 to 300 million. But to be honest with you, you'd be very happy with a 27.1% analyzed return for a company over a 10-year period. However, when you look at the chart, you'll notice one special thing about Lindsay Australia. If you held onto this company over that 10-year period, you only saw most of those gains in a very short time span. So let's have a look at the chart of this company right now. So this is the weekly chart of Lindsay Australia going all the way back to 2013, and actually it does include the period from June 2023 to now. But you'll notice that for a long period of time here, the share price of Lindsay Australia absolutely did nothing. So from 2015 all the way through to almost the end, probably we'll say the middle of 2022, share price went sideways. In fact, share price went down during that 7-year period. But from the middle of 2022 to around about May 2023, and that's very important. The share price high for this company was around May 2023. But during that period, almost a 1-year period, from the middle of 2022 to middle of 2023, share price of Lindsay Australia went from 40 cents to $1.40. The other important thing is, if you go back to May 2023, share price of this company was around about 15 cents. And then the share price went from 15 cents to about 48 cents from over a 2-year period. So really good return from 2013 to 2015. Did nothing for about 7 years, and then a good return for a 1-year period from the middle of 2022 to from the middle of 2023. So this is not the sort of chart you might expect from a company that has performed well over a 10-year period. It doesn't go from the bottom left to top right in a straight line. There's long periods of time when the share price of this company did absolutely nothing. Coming in at number 9, we have a company I know nothing about. I've done zero research on CYO Farm. Ticker of this company is CYC. There are a few reasons why I have done zero research, which I'll touch upon in a second. But if you've been a shareholder of this company, you're very happy chappy right now, because the market cap has increased from 10 million to 175 million. Shares in issue have increased from 57 million to 93 million. So they've almost doubled, but that's understandable because 10 years ago, the company had a market cap of $10 million. Now, one of the reasons why I don't or haven't done any research on this company is, even though the revenue has grown from about $10 million in 2013 to $27 million in the last financial year, is because the company has not been profitable for 5 years. In fact, they've had 5 years where they've been unprofitable. So that alone means I have done very little research, or wanted to do very little research on this company. So that's why the earnings per share growth is negative, because they went from being profitable to being unprofitable. That's why dividend growth is not applicable. I'm not even sure if this company has given shareholders a dividend in the past 10 years. Now, the revenue has grown at 8.6% per year. So that is one good thing about this company. Gross margins 62.2. That's actually quite nice. I do like the gross margins. And because this company is not profitable, return on equity is negative. So that's another reason why I've done zero research on this company. No return on equity, not profitable, that sort of thing. But again, you're a very happy investor of this company if you bought shares in 2013, because the analyzed total return is 29.1% per year. Now let's have a look at the chart for CYO Farm. And to be honest with you, if you look at the period between 2013 and 2021, what a beautiful chart. Share price actually went from about 10 cents to a high of almost $3.50 in the beginning of 2021, towards the end of 2020, beginning of 2021. But since then, the share price has been quite volatile. You can see massive movements in share price. There've been downtrends and uptrends since then. So yeah, and that's sort of understandable because companies are not profitable, and because rising interest rates, unprofitable companies have been completely decimated by the market. And the share price actually went from 350 all the way back down to $1 in June 2022. And that was probably the bottom of our market, if I remember correctly. June 2022 was a low point. So that was the low point of CYO Farm. And the share price went from $1 back up to over $3 in the next year. So a lot of volatility when it comes to CYO Farm, which is very unlike what happened or what you see on the chart from 2013 all the way through 2021. Share price in a well-defined uptrend. Another company I don't know much about is Joyce Corporation, the company that comes in number 8. I'm pretty sure this is some sort of retail company that does beddings and kitchens. But again, just like CYO Farm, I've done very little research on this company. Seems like they've been around for a long time, since 1886. And maybe the lack of research on this company has been a detriment to me, because unlike CYO Farm, these numbers are impressive. The market cap of this company has increased from 11 million to 74 million. No increase in shares in issue, which means this company has not needed to go back to the market to raise capital because they've been profitable over the past 10 years. Revenue growth of 26% per year, earnings per share growth of 15% per year, dividend growth of 23% per year, gross margins of 53.5, which is pretty nice for this type of company that's in bedding and kitchen, return equity at 16.6. Everything is a tick. When I look through my checklist in determining whether a company is high quality or not, all ticks an analyzed return of 29.2% per year. So again, why have I not done any research on this company? It looks like, just based off these numbers, a pretty good company, perhaps even a burgeoning high quality company in the future. And we look at the weekly chart, nothing much to dislike about this chart at all. Back in 2013, share price was below 40 cents. Now, as I speak, the share price is above $4. So this has been a 10 bagger from May 2013 all the way through to April 2024. And the share price is near an all-time high. Now, just like many other companies, a bit of volatility in the share price of this company since the start of 2021. And maybe that's because this is a retail company and the market's been unsure about retail companies, sometimes fairly bearish. That's why you see many retail companies' share price fall off a cliff. And sometimes the market has been a little bit more bullish. And that's why we have seen a bit of a roller coaster when it comes to this company's share price since the start of about 2021, particularly from the start of 2022, because the share price went on a massive tear from the bottom of the COVID-19 panic. Share price was 80 cents to the highs we saw towards the end of 2021 when the share price was $4. So just in that 2-year period, this was a 5 bagger. So a nice looking chart for Joyce Corporation. And I noticed just by looking at last week, share price went on a nice tear from 350 up to 430. So I'm wondering what happened during that week. So possibly I should be doing research on this company. Coming at number 7, I do have have had a little bit of exposure to in the past. I have traded TPC Corporation because it looked really cheap about 2 or 3 years ago. Unfortunately, I then sold out to take profits, and the share price kept going. Well, it didn't really keep on going up. And again, this company has been really volatile. But just last week, there was a takeover bid for this company, and the share price has popped up. Now, TPC Corporation is a retail energy company. I think when you say energy, electricity, I'm not sure if they do gas, but definitely electricity, and a fairly small company at that. And you can see that just by the markup, increased from $5 million in 2013 to $52 million by May or end of May 2023. And right now, I think the market cap of this company might be over $100 million. Shares in issue, not many at that. 11 million, and it hasn't increased over the past 10 years. And again, just like Joyce Corporation, really impressive numbers. Revenue growth of 20% per year, earnings per share growth 11% per year, gross margins of 26.7. I would expect gross margins in this space to be a little bit lower than some of the other companies, but return on equity 35.5, really impressive. And I think because of that return equity, or that impressive return on equity, nice revenue growth. The analyzed total return of this company is approaching 30% per year from 2013 to 2023. Unfortunately, because of this takeover bid for the company, I don't think this company will be on the ASX too much longer. As we take a look at the chart for TPC Consolidated, you might be able to notice that from 2013 all the way through to middle of 2020, share price of this company did absolutely nothing, went sideways for that 7-year period. And to be honest with you, for that 7-year period, I did not know this company existed. And then in August 2020, I took a look at this company's financial results, and I went, look at the market cap of this company. It's really low. I think it was like $5 to $10 million when I had a look at the financial results. And I went, this company looks really, really cheap. So I bought some shares in this company at $1 in August 2020. And it does look like the market saw what I saw just after I did. So this was pretty good timing on my behalf. I have to give myself some benefit here because I bought at $1 and then 9 months later, it was even less than 9 months. Yeah, about 9 months later, I sold at around $4. So a nice four bagger for me in a fairly short period of time. And around when I sold, those tailwinds the company was experiencing, because this company sells electricity. I think it's a retail electricity company. Those headwinds in regards to low wholesale electricity prices were coming to an end. And the reason why the share price then dropped from $4.50 to $1.50 over the next 2 years is because of those headwinds. But then those headwinds became tailwinds again in the middle of 2022. And I was paying no attention to this company. And that's the reason why the share price of this company went from $1.50 all the way up to $10.50 towards the end of 2023. In fact, looks like it was the start of 2024. Share price dipped during the first 3 or 4 months of 2024, went from $10.50 to $6, and then the takeover bid for the company at about $11.50. So if I held shares in this company after I bought and did not sell, this would have been a 10 bagger for me. Would have been a 10 bagger instead of a 4 bagger, but I'm okay. I'm okay with taking profits when a share price has increased fourfold over a 9-month period. I'm definitely always going to be thinking of taking profits at that point in time. My only regret, even though it's not really a regret, is not paying closer attention to this company after I sold and seeing some opportunities in the middle of 2022 when the share price fell below $2. And finally, we get to number 6, Jumbo Interactive, to go to JIN. When I looked at this list, this was one company I was not surprised to be on it. I absolutely expected Jumbo to be on this list, and I would probably argue this is a high quality company, or very close to high quality company. You can see that with the numbers. So first, the markup. Markup of this company has increased from 66 million to 914 million. That's a pretty significant increase in markup. Shares in issue have increased by about 50% from 44 million to 63 million, but it's understandable. Many companies that have increased their markup by that amount over a 10-year period more than likely have done at least 1 or 2 capital raisings during that 10-year period. Not all of them, but some of them. But then you have a look at some of the financial metrics. Revenue growth of 18.4% per year. Earnings per share growth of 26% per year. Dividend growth of 31.7% growth per year. Gross margins 84. That's a really nice level to see gross margins at. Return on equity 35.2. So all the hallmarks of a high quality company, a high return on equity, really good revenue and earnings per share growth, even a nice dividend growth, and really good gross margin. So no shock to see the analyzed total return of this company is greater than 30% per year over that 10-year period. Now, one of the reasons why I was not shocked to see this company on this list is just the share price appreciation of Jumbo from 2016 through to 2019. It was only a 3-year period where we saw significant capital appreciation of this company. From 2013 through to 2016, this company did nothing. And again, this is another company I did not know existed. Had no idea this company existed. Then share price moved into an uptrend towards the start of 2016. Share price at that point in time was around $1. And then share price went from $1 to a high of $28 by the middle of 2019. And that was a share price high for this company. So much of that return if you held on to this company for a 10-year period, happened in that 3-year period between 2016 and 2019. You can see the share price absolutely fell off a cliff in 2019. Well, from the middle of 2019 to the COVID-19 financial panic, share price went from $28 back down to $7. So we're talking about a 75% decrease in share price over a short period of time. But since then, since the COVID-19 lows, the share price has been gradually rising. It's been slow, but it is gradually rising. And that is all I have for this look at those companies that came in between 10th and 6th of the best performed ASX small companies with a market cap below $1 billion between 2013 and 2023. Did any of these companies surprise you? I probably only had one significant surprise in this particular list, and that is CYO Farm, a company I know nothing about, but the company has been loss-making over the past 5 years. Earnings per share has been decreasing. So even though revenue has been growing, we do see some red flags with that particular company. But otherwise, you see some really strong growth, some really impressive numbers, particularly when you're talking about Joyce Corporation, also Jumbo Interactive, really nice numbers there as well. So do you have a favorite company among these 5, or are you a shareholder of any of these 5 companies? Love to hear your thoughts. So leave those thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.